Hey guys, welcome back to BlockParty Trading. I'm going to be doing some more BTC analysis today. So I think, in a nutshell, I think I'm very positive, very bullish long term. And what we wanted to do is kind of focus in on a few of the reasons why are forecasting so bullish. Last time out, we looked at some of the more kind of esoteric and technical sort of indications, the pi cycle reversals on the logarithmic growth chart. This time I think we're going to drill in on something a little bit more standard in terms of technical analysis, but interesting nonetheless. It has a mirror back to an event earlier in 2023, which kind of kick-started this large rally as well. So there might be some additional significance there in terms of this cycle of the market. So what we're doing here is we're just looking at the weekly chart, and really we're looking at this kind of big bullish move that we had. So everything from that point, what's happening. So effectively we're in a period of consolidation, and we can draw in a trend line showing that we've got some lower highs there, and a second one here showing some lower lows. So effectively what we can see is that we've got a falling wedge, which is a traditionally very bullish formation. So this period of consolidation, what we're seeing is lower highs and lower lows, and we would generally expect to break up and out of this in a bullish manner. What's interesting about this formation is that we can see a really nice echo to it from earlier in the year. So if we have a look here, a similar trend line there, the lower trend line coming across here. And what we've got, again, a slightly larger falling wedge, which really formed following this dramatic breakdown, which was, I believe, let's have a look, 13th of June. I think that was the Celsius collapse. Again, we consolidated just as we have done, and then saw this dramatic breakout, which was the very early part of 2023, which kick-started the rally that we're currently in, this kind of very, bullish start to 2023. What's interesting about these two similar formations is that we also have this additional confluence, which is the moving averages. So we've got the 20 moving average, which is the green line, and the 50 moving average, which is the white line. And we can see during this consolidation we were bumbling above and below these points, definitively broke out, which led us all the way up to the secondary consolidation, which we're in at the minute. And we can see again that the price following the breakdown last week is again starting to challenge these trend lines. So it would be my kind of understanding that if we were to break above these 20 and 50 week moving averages, that then we would break this trend line and be off on a dramatically kind of bullish move. The one slight difference, and it's an additional benefit of the formation that we're in at the moment, is that back in January when we made this breakout, we crossed the 50, the 20 and the trend line, but we still had to contend with the 200-week moving average. When we did break out, we kind of got, again, this definitive move here. This time, we're well above the 200 moving average. So this really gives us a completely clear breakout. We don't have that long-term moving average resistance that we had previously. In terms of targets for this move, I think we highlighted this on the last video, can't fully remember, but what we've got here is an unfilled CME gap. So the way this works is the Chicago Mercantile Exchange closes for business on a Friday and reopens on Monday. These gaps represent any kind of differentiation in price between the close on the Friday and the open on the Monday. And with unerring accuracy, these gaps are refilled. So we can see, similarly, we had one here from June. Price had broken down dramatically during the weekend when the exchange was closed, and we stayed under that price this whole time before we filled it back in the middle of March. So we're going to expect the same thing to happen here again. We had this is where price would have been on Friday. This is where it was on Monday. So we'll expect price to come up and fill this gap at some point. So if we are looking at a bullish breakout from this falling wedge formation and a break of the moving averages, that is going to be my target. Potentially, this week we might have a trigger point which will get us over the moving averages. Potentially that's going to be Chairman Powell, Chairman of the Fed, who's speaking on the 19th. So I think that's Thursday. That speech, what we're going to be looking for is confirmation that we're going to get an interest rate pause, or even, very bullishly, an interest rate reduction. Again, whilst we're speaking of the Chicago Mercantile Exchange, if you want to kind of keep abreast of how likely those rate pauses or rate reductions are, you can go to the CME website, and they've got this thing called the Fed Watch tool. It basically gives you a percentage chance of different outcomes. So current target rate is 500 to 525. So to get a 500 525 rate, basically a rate pause at the meeting on the 14th of June, it's a 78.8% chance. And going up to a 525 to 550, which would represent a 25 basis point hike, only has a chance of 21.2. So the interest rate pause looks broadly priced in, but maybe something in Powell's speech later in the week gives us this breakup to fill this old CME gap. An invalidation scenario would be, you can see that we're at resistance with the moving averages. If we continue to break down or track below them, then that's entirely possible. But we would still be staying within this falling wedge formation, which is still bullish. If we were to close, however, a weekly candle below this trend line, I think that would invalidate the formation and therefore the hypothesis for the breakup. Anyway, any comments down below? Really interested to hear what you think, if you're as bullish as we are. And I'll speak to you soon.